Did you know that for many years foreign investors could earn thousands of crores in India and pay almost zero tax completely legally? They did not break the law. They simply used a strategy called treaty shopping. But now India has tightened the rules using GAAR, international tax reforms and Supreme Court judgments. In this video, I will explain what treaty shopping really means, how it works with simple examples, why governments oppose it, what Indian tax law now says, how this impacts investors and startups. Let's begin. What is treaty shopping? Treaty shopping refers to practice where an investor routes investments through an intermediary country mainly to obtain tax treaty benefits rather than for genuine commercial or business reasons. In simple words, you choose a country not to do business but to save tax using its tax treaty. A simple example of treaty shopping, let us understand this with a simple example. Suppose a US investment fund wants to invest in an Indian startup. If it invests directly, that is from USA to India, capital gains tax in India is 20%. But earlier, due to tax treaties, if the same investor routed investment via, say, Mauritius, that is USA to Mauritius and from Mauritius to India, then capital gains tax in India is 0%. So the investor earned huge profits and at the same time zero capital gains tax. This routing was done not for business reason but purely to take advantage of tax treaty benefits. This is treaty shopping. Why Mauritius and Singapore were popular? Mauritius and Singapore became the most popular treaty shopping routes into India because India-Mauritius tax treaty earlier provided full exemption from capital gains tax. Likewise, India-Singapore tax treaty provided low or zero tax subject to certain conditions. As a result, more than 50% of foreign investments into India came through these two countries, even though the actual investors were based in US, Europe or other countries. Why governments oppose treaty shopping? Governments oppose treaty shopping because it leads to massive tax revenue loss, artificial corporate structures, base erosion and profit shifting, also known as BEPS, unfair tax advantages. In India's case, thousands of crores of tax revenue were lost every year. So the government introduced anti-avoidance laws to stop aggressive tax planning. Legal provisions against treaty shopping, GAAR, that is General Anti-Avoidance Rules. GAAR empowers tax authorities to deny tax benefits if the main purpose of a transaction is tax avoidance and the structure lacks commercial substance. GAAR allows tax officers to ignore artificial entities, recharacterize transactions, tax income as if the structure never existed. Another very important concept in this regard is principal purpose test, that is under MLI and OECD and BEPS framework. Before understanding PPT, principal purpose test, Let us first understand three important global tax concepts in a very simple language. Number one, OECD, Organization for Economic Cooperation and Development. OECD is a group of developed countries that work together to create fair and uniform global tax rules so that companies cannot escape tax by shifting profits to lower tax countries. BEPS, that is base erosion and profit shifting. BEPS means reducing a country's tax base and shifting profits to tax haven countries to avoid paying taxes. To stop this, OECD launched the BEPS project to prevent tax avoidance, profit shifting, and misuse of tax treaties. Multilateral instruments, that is MLI. MLI is a single international agreement signed by many countries, including India, to quickly modify their existing tax treaties and insert strong anti-abuse rules without negotiating each treaty separately. Now let us understand Principal Purpose Test, that is PPT. India adopted the multilateral instrument, that is MLI, developed under the OECD BEPS framework to modernize its tax treaties and prevent treaty abuse. As part of this global initiative, the Principal Purpose Test, or PPT, was introduced. Under the PPT, tax benefits can be denied if it is reasonable to conclude that obtaining such benefit was one of the principal purposes of the transaction or arrangement, unless granting the benefit is in line with the object and purpose of the treaty. In simple terms, if the main purpose of a structure is tax saving and not genuine business, then treaty benefits will be denied. This ensures that tax treaties are used only for legitimate business purposes and align Indian tax laws with global anti-abuse standards. Supreme Court ruling, Tiger Global case. In the landmark Tiger Global case, the Supreme Court ruled that if an entity lacks real commercial substance, tax treaty benefits can be denied. This judgment provided a strong legal backing to the tax department's fight against treaty shopping and reinforced the principles of substance over form. To summarize, treaty shopping was once legal, but today aggressive treaty abuse is strongly discouraged and penalized. India now follows global standards of transparency, fair taxation, and anti-avoidance. This is C&IP Praveen Agrawal thanking you for watching. I hope this presentation will be helpful for you. Please subscribe to the channel for more such informative videos. Thank you.